This is going to be a detailed and complex, fairly inclusive lecture set about using our models for core options trading strategies and even developing our models a little bit more. I think this will be in 3 parts or possibly 4. The most important part will be the second part, which will follow this. And in that, we're going to go back to the beginning and build some things from scratch, now that we know how these models work. So let's get started on what we have here. Now, we've seen these before. These are the graphs we use in Econ 104, for example, to demonstrate why people buy options and what has to happen for you to make money with an option. And I'm using as an example actual active options that existed, and we even considered trading during the week in which I made this video. This one here we're looking at is a Netflix May 15, 4:35 call with 30 days to expiry. And this is still an active option because today I think is the 18th or 19th or something like that. And so this was taken from a quote at Interactive Brokers, as is the case for all of the examples here. And I pulled this out on, let's see, April 14th when Netflix was $429.11. And this call could have been purchased at 28.20, assuming the peg between bid and ask at that time. So you've seen these before. Of course, I wrote a Python program that allows me to take a current option that maps out these kinds of call option value mappings, as is true of everything in this video set. So we're able to use contemporary values. Now again, I remind you, you've seen this before. We've got the stock price represented as the green line, strike that's out of the money as the red line. It has a value of 28.20. And then the orange and blue lines show what happens once the option comes into the money, or what it will be worth at expiry. And again, though, that's the limitation here. This shows what the option will be worth if held to expiration, given the possible prices of Netflix. And we're using Netflix for a reason that'll become apparent here. This is the put, or a put, that's similar. This is the May 15th, 2020. Out of the money 425 put with, of course, the strike price below the price of the stock. This would have been purchased at a price of $29.10 on April 15th when Netflix was $429.81. A price that was slightly different because I pulled these prices out with a program and posted one up, went back to get the next one. Of course, the price was a little bit different when I did that. So again, you've seen these. This is how people are typically introduced to options trading in Econ 104 and classes that are taught by others because they're easy to explain. They show what would happen if the stock rises above the strike price. And also it shows the attractiveness of options because, of course, if it rises above the strike price for the call, or in this case, below the strike price for the put, then it seems to demonstrate that you can make an awful lot of money. This option also shows a break-even, which most of them don't show. So you know you have to get to the break-even point before you actually make a profit because you have to cover the cost of the option. Now, we know, though, that these mappings give a very false impression. And we even know what that impression is. It's going to be the case that you don't normally hold these options to expiration, and this might give the impression that you can't make a profit on this until such time as it expires, or it's not possible to, or you wouldn't want to. But we know normally you don't hold an option to expiration, or you don't have to at least, and so you can trade it out. One might say this is better, a European option model, but that's even misleading. You can make plenty of money on European options just like American options because they rise in value just like American options do, or fall in value as various parameters change, and you can sell a European option at any time you want. The difference between the European and the American model is you can't assign an American option. I mean, you can't assign a European option until the expiry, or you can't execute it until expiry, but you can, of course, with the American option. But that doesn't have quite the effect upon option pricing as most people seem to think that it does. Okay, let's explore what else we know to make this simple approach we're taking more realistic and a little more subtle. And I'm going to mostly cover what you could have used or perhaps have used if you have been using the models that I sent you. So let's take a look at this. First of all, the model that was sent to you, or it was at least loaded on the website for you to use. I didn't give you an assignment telling you to use it, but you could have. And you should perhaps play around with them because I did suggest that. The model that we called call IDV, either QD or it may have had a slightly other name. I don't know which version I gave you. The QD in my model names always means quick and dirty, and this is a quick and dirty model. That model allows us to calculate the probability of being in the money at expiry, which was almost exactly 50%, as you can see there where the red arrow is pointing. If we look over to the program and we ask ourselves, how did we do that? Well, the key expression from the program that I gave you calls upon this utility in the financial utility setup I gave you called COPO-PITM, and that sends out a tuple that tells you the stock price. It sends out a tuple, that gives you the some of the parameters that we're trying to seek, including the delta, the probability of being in the money, and the implied volatility. So right here, we're looking at the probability of being in the money because we also developed a model independent of this as the very first thing we did in the class to make sure that we understand why when you use the Black-Scholes variant, which is what this is, that it's consistent with what we did earlier. So what you're using here is the Black-Scholes variant, and you can see that it is solving for this range of parameters by solving for the options value. And down at the bottom, we can see inside of the financial utility, COPO-PITM, that we see how those are being solved again. And down at the very bottom, we have the graphics illustration from the Black-Scholes lecture reminding you that this probability is equal to the value referred in that lecture as D2. It is not the case, by the way, as so many people teach and explain, I don't know where this comes from, that this is equal to the delta. This is definitely not equal to the delta. That's the solution for the other half of it, not for D2. So we know that much so far. So there's a mistake I made, though, when I wrote that model for you. I don't use Black-Scholes models for the stuff I do. I'll show you later on what I do. When I typed out the output, I called this the calls. See where the red line is? I called it the calls implied probability. That's misnamed. That should not say that. It should say the calls implied volatility, not probability. So that change you might want to make to your model so as not to be confusing. I just noticed that when I put this lecture together. Okay, so if we take this information here, the probability of being in the money, and go back to our model, let's look at the call option only, for example, then we know we have more information. Now we know the probability of being past the red line, but still this is at expiry, because that's what this calculates. So it's adding new information to the old model, and we could even look for more. It would be easy to estimate the probability of breaking even on this as well, using a very similar technique to figuring out the probability of being in the money. And the model doesn't do that. Some of the models I have do that. But we still have essentially the same problem, which is this gives the impression that you have to hold the option to expiry, when normally you don't want to do that. So we need to expand and apply our parameters a little more deeply using these models. So let's keep going. Now we know this. This was taken from Interactive Brokers on the same day that I prepared those lecture slides, and the prices are very close to what they were on the examples I've given you in the graphs. For example, we're looking at the May 15 expiry, which is 30 days away, and that's the expiry all along that we've been using as an example. Now, let's look down here at the slide about the Netflix performance on that day, the little chart on the bottom left, and you can see that Netflix has been rising in value on that day. April 14th was the day before. April 15th was the day where we made these estimates, and some of the estimates later on were also made on April the 17th. So as I say here, the previous slides may give the impression that one will make a profit only if the option finally goes above the strike price for the call or below for the put. But logic tells you that as an out-of-the-money call approaches the strike price, the call will rise in value even though it's still out of the money. So generally, if the price of the stock goes up, the value of the call will rise, so long as no other variables change like volatility. So this slide tends to demonstrate that because, again, down in the graph, we see that Netflix is rising strongly actually on that day, which was the 15th. And you can see, if you look at the changes on the call side of the option chain on the top of the page, they're all sharply green and up in value. And if you look at the put side, they're all red and down in value. It seems disproportionate, and that's for a host of reasons that we're not going to explain here. It's also the case, again, that they use discrete values to calculate these percentage changes when they should be using logs. But that's neither here nor there. It's clear that the calls are rising in value, and that has nothing to do with holding it until expiry, and the puts are falling in value. And they're doing it because Netflix is rising in value that day. Now that means, of course, we know that's true because the delta, which is the sensitivity of the options price to a change in the underlying, is non-zero. And using the same model, as you can see here on the left, to pull out the value of the delta, and that actually falls out of the financial utility program called COPO-PITM, that, as I say, we have a delta of about 56 cents, and that measures the sensitivity of the option price to the underlying, the delta, at 56 cents. So we know that that tells you more or less that if the price of the underlying rises by, say, $1, this option is likely to rise in price by about 56 cents, with some qualifications maybe. Now, I gave you this mapping. I gave you a simpler version of this mapping somewhere along the line, or I put it in a lecture, in the lecture about the Greeks. And I'm repeating some of the material from that lecture, but we go past that lecture at some point here. And here we are looking at the actual Netflix call option deltas on this same day. Again, we're assuming the 30-day volatility of 0.048, and we'll explain where we got that from, using that with a Netflix price of $429.11, which again was the price. This is the mapping of the call option deltas for 3 strikes. The strike that we're using as an example is the 30-day strike. It's out on May 15th. And the specific option, call option we're looking at is where the red arrow is pointing, which, if you recall, was the 435. We see also, though, that we have the chain represented 16 days out and the chain represented 9 days out. We're going to go back and look at the 9-day chain here after a while because we may want to trade that. The reason we're in Netflix is because we're thinking about actually taking a trade in these very options I'm talking about here in this video. And you'll also notice generally that the delta changes, the delta of course gets progressively flatter the farther out the expiry on these. So of course if you're dealing with near-term options, you have very steep, I should say, examples of, or I should say, relationship between the value of Netflix as it changes and the call option deltas. So, continuing on, this implies, therefore, that when you take this 0.56, that is what explains this. That's primarily where the explanation comes for why the call column is green and why the put column is red. There are some limitations, though, to the delta, and I'm using the Black-Scholes version of the delta here because it's built into the model that I gave to you to play around with. That's where the delta is coming from. You may recall that there's a limitation to the delta because it is a tangency estimator in a very nonlinear system. And so as the previous slide actually showed, the delta changes itself at every strike price or at every movement in price actually, and it changes in the way that the slope of those lines suggested, which is why it's also necessary if you're only using Black-Scholes, which is actually what we're not going to be doing, that you need to also consider the gamma. The delta, remember, is effectively the first partial derivative of the options price with respect to the underlying price. The gamma is the second partial derivative, and that tells you how much the delta will change as the price of the stock changes. So we keep that in the back of our mind as we consider this when we think about options strategy. Let's see, we also know the all-important implied volatility of the call. Now, the model that I gave you, the model that was called call IDV.quick and dirty, was in fact primarily designed to calculate the implied volatility of the call. And if you look back over to the left side of the screen, down at the bottom, this was a documentation in there that said we are using divide and conquer. And what that means, of course, is that this model does not have a solution value for implied volatility. What you have to do to solve for implied volatility is just take the traditional model, plug in an arbitrary volatility, and it's not going to give you an accurate price, of course, and then continue to converge on that model until you get a price that is very close to the actual market price of the call, given whatever tolerance you have measured. And at that point, then you can assume that the volatility example that you use to solve for that is the correct estimator for implied volatility. In that model on the left side, implied volatility is actually that variable called CIPD, call implied probability. Let's see, CIPD, I forgot what that's supposed to stand for, but it is implied volatility. And so you can see how the divide and conquer algorithm is just causing it to converge to a value that is going to solve your model at a level of precision that you set up there at the very top. Okay, now we need to do something with that implied volatility number. You haven't heard anything about that yet, and that's where this gets complicated. So let's see what else we have where we can make some sense of whether we want to do a trade in Netflix, for example. So I also gave you a standalone model called HVIEX short, or I called it HVIEXQD. I have two versions of that model. It's an ultra short model that's in Python rather than Jupyter, and the QD again stands for quick and dirty. It's a very much boiled down version of the really large Jupyter model that measures everything you can get out of the historical data. That model I'm also going to give you probably sometime this week. If you ran that model, which requires that you have an account, a free account at IEX Cloud, and you have the token that allows you to log in remotely from a Python program, all of which you're supposed to have done in this class, then you will get this output right here. You will see you have three, not one measure of historical volatility, looking here where the red arrow is pointing. 1 year, of course, represents 252 observations, so calculating historical volatility over that range. 90 days is just the most recent 90 days over that range, and 30-day, of course, is the most recent 30 market days, which is 6 weeks. And you can see that in this example that the 1 year goes from 0.026 to, for the 90-day, 0.033, and for the 30-day, 0.048. Now, you know that's not normal. If we gave some examples a little bit earlier in the class, and the 1 year, 90-day, 30-day were all pretty close to each other. But of course, this is being recorded in the crazy market of March and April and eventually May of 2020 when we had the Black Swan event. So of course, a substantial rise in the volatility measure for the 30-day represents the fact that implied volatility for SPY and all options just exploded up in value, and that was reflective of the actual crazy volatility of the market itself. Now, what this is capturing is the crazy volatility of the market itself, because this is taken from actual observed data off of IEX Cloud. So this shows that the market itself has become more volatile, because remember, these are averages of log growth rates, pretty much, is what you're looking at here as a standard deviation. So we got that, and we have the estimate for implied volatility. We haven't yet discussed what you make of tying them together. Now, admittedly, the black swan event that we're having, or had, and this is the tail of that tapering off a little bit, makes this more difficult to do, but I think in another sense is far more instructive for us, far more instructive. We're learning quite a bit more because that has happened. So let's go back and take a look at our implied volatility that we estimated, which is represented down on the bottom left with the blue arrow. All right, so it says 0.02854. And you say, okay, shouldn't that come pretty close to historical volatility? Well, in a very stable market, it will come pretty close to it. In this kind of market, maybe not so much, because remember, the 30-day and the 90-day are simply moving averages. They're not even as high potentially as the actual volatility right at the moment, because when you have a black swan event, all of a sudden you have one massive dislocation, but say 28 normal data observations, so the 30-day average doesn't move up very much. Only when you are 30 days past the black swan do you get an accurate measure for the 30-day volatility measure, historical volatility of the actual black swan event. And we're pretty close to that now. At any rate, you say, let's compare it. And when we do compare it, we see that it actually compares very closely to the 1-year volatility. And you say, oh, that's interesting. Well, maybe this is actually a pretty good model. But then that raises the question, why would it compare to the 1-year volatility? Because you would think that a current options price and its implied volatility would be much more reflective of the extreme volatility of the present market. It turns out that for some options that's true, but not all, because one more thing we have to look at here and measure is this. We have a 30-day option, and that's pretty far out as far as options go. I mean, you can look on a options chain and say they go way past this, but when you look at liquidity tracks, you know, what's liquid out there, it doesn't really get much past this. Everything past this, 30 days or so, is not very liquid at all. And so those options may be there, but they're not being traded. This is still a liquid option at 30 days out. And so it is reflecting market information to some extent. So we say, well, you're explaining this by saying it's a 30-day. Can you amplify that a little bit more? So we need to do that also. But here's the point. We have matched the implied volatility to an historical value, but it is the 1 year, and that's a little confusing because option prices are supposed to reflect current volatility, not long volatility is actually no longer relevant. But not so true for 30 days, as we're going to see. So let's take another look. Now, this model you don't have, and the reason you don't have it is because this model is a daemon that logs into interactive brokers and sits there in this little machine sitting right over here, right here, underneath us here. It's not on now because the markets aren't open now, and processes a whole bunch of these models all day long, about every 15 minutes or so. And so these are Strangle trackers to some extent. So if you look at the one on the very top, you can see this is Wednesday, April 5th. This is tracking a call and a put, as you can see, and this is a 9-day maturity. So this is pretty close, and it's Netflix. And again, this is being run by this little Linux program here running off of cron that takes the Python program called ib.strangle in pause, and it actually records it to a log. And we're looking at the results of the log. And these are some of the entries for April the 15th. Now, when I say it's a Strangle tracking model, that means it has a bid and an ask. It has a call and a put. It also calculates the position cost, but more importantly, it calculates the call's implied daily volatility and the put. And take a look at that. Now, this was done on the same day as what I just showed you a moment ago, that had an implied volatility that was equal to the 1 year, the 0.026. Now, look at this one. The 9-day option, which is, by the way, chosen by the model itself, not by B, to be right at the money around the actual stock price. And we take a look at this and we get 0.05. And you say, oh, that's much more like it, right? That's what we would expect in a crazy market like this. And we compare that, you say, well, that's closest to the 30-day. It's even above the 30-day. The 30-day was 0.048. This is 0.05, pretty much the same for the call as it is for the put. So that's a little more easy to understand and a little more believable. But let's go out another few days. Let's go out to 16 days. Look at that. It's the same option, except it has a different expiry, but the implied daily volatility has dropped to about the level it is at 30-day, but actually a little below that, 0.042 and 0.042 for both of them. Again, the put and the call sort of evenly priced. I don't have an example here, by the way, where the call and the put are priced differently. That happens on days when there's a massive market move one way or the other. So if there's a big plunge in the market on a given day, the puts become more expensive than the calls, and the puts, in fact, will have a higher, therefore implied daily volatility. Remember, the daily volatility value is perfectly correlated with the premium on the option. So the higher the IDV, the more expensive and out of the money option is. The more expensive and in the money option is, because the higher the premium on that option. Now let's continue on down and we look at the 30-day that we had seen before. Now this one is done a day later, and so the IDV is 0.03 and 0.033. And you say, well, that's closer to the 90-day than it is to the 1 year. And so again, but these were done at the same time, though. So again, you say, well, how can you figure out how to match this stuff up? Well, generally, the rule of thumb is, from looking at this, that if you're close to expiry, it's going to be correlated most strongly with the shortest historical volatility that you're estimating. As you move out on the chain, and you get more distant expiries, especially when you get out to 30 days, then those are going to be lower volatilities, more correlated in an environment like this with the longer term measures of historical volatility. Then also on top of that, though, there's one more complicating factor that really makes this confusing potentially. This is 1 day later, and it's still higher than the estimate that we made earlier, which is 0.02 something. This is 0.03 something. But I chose these because we are approaching an earnings date. And all of these models were working because they were trying to evaluate whether we should do a Netflix strangle on the earnings on Friday, the 17th. And so I set these in motion on the 14th. This is the results they produced on the 15th. And those models are still running, evaluating whether we should move into that strangle. In the past, Netflix strangles have been some of my most productive bets. I made $5,000 or $6,000 once on a single contract each side, Netflix strangle. I think the summer 2018 that happened, because Netflix really reacts to earnings. So I thought maybe we should play this. We would not have done the May 15th, 30 days out, though. Our strategy won't do that. It doesn't make enough money. We would have done this one. So the first ones I actually did was not the May 15th, because I was thinking about doing a strangle. We did the April 24th, which, as you can see, is 9 days out, not 30 days out. So this is going to be quite a bit more volatile, potentially, than the 30-day that we're considering. So as I write right here, and this was calculated at a slightly different time, I think it was a day later, the stock price was 432.31. Before, I think it was 429 something. The strike value was 25.67, and we're looking at a 435 call. And so you still have the option value the position break even. Again, that's not as relevant, although in this case, as it says here, we chose a call that will expire on the Friday after the Tuesday earnings report. So this actually does have some relevance. This was half the strangle I wanted to do at the time I was considering these strikes, which change until I actually make the trade. And the earnings will be, if you see this before Tuesday afternoon, will be, if you see it after Tuesday 9, have just been on Tuesday, April the 21st at around 3 o'clock Pacific Daylight Time. So in looking at this, this is the call we were considering at that time. This is the put that we were considering at that time. And so I need more information than I have provided so far. We see the sort of tangle that arises from the historical volatility, some confusion over which one is most relevant for what you're trying to do. Although for an earnings strangle, the shorter term volatility in an environment like this where they are very, very different is the relevant one you have to use. On the other hand, if it's very stable, I usually use the 90-day, and I've upon occasion even used the 1 year. But typically that's because the 1 year, 90-day, 30-day are not all that different from each other. The reason you would go out a little bit is because you're using a smaller sample size for 30, and frankly an inadequate sample size if you're trying to, test the integrity of your estimate. With 252 days, or I even do a 504-day estimate in the big model, then you've got a big enough sample size. Okay, so the model I ran, though, to actually determine whether to do this trade was a little bit different than the one that I've been talking about so far. If you take a look at one of my models that has the term in pause in it, that normally means that I have actually moved into a position and it's going to track that position until I tell it to stop tracking it or until the option expires. So in pause means in position. So the way I do this is I take one of the earlier models I talked about and I set it loose and I say, go find the pairing of put and call that I need. Give me the best price, give me the best spread, and it does that. And then once I get that result back, then I set this model in motion using the strike prices that the other model chose. And then this one will track it all the way to the end. Now, if I actually take the option position, then I run another version of this model that is, this means this hypothetical position, right? Because we have two here. We don't own both of these chains. Here we want to see what happens to the in position chain that's 7 days out. Let's compare that to 28 days. Let's see which one of these makes the most money or whether either makes the money, right? If I'm actually in a trade, then of course I run one on the specifics of the exact trade. So of course, even though when you start, here's a strike price and then here's a call and a put around it, as the original model keeps finding the best price, that goes up and down with the price. But once we're in position, this stays here and the stock goes wherever it goes, up or down either way. So and therefore you can see, if you look at the top one, this calculates the position profit or loss, as you can see. So the position profit or loss is something you have to be completely aware of. And just above that, if you look at the top one, the position value is what it's going to cost to get into this option. So this one was run on the 17th. And I ran it on the 17th because that was the day I was going to make this decision. The 15th was too early. Look down at the bottom where it says on each of these time decay. The time decay on the top option is $3.73 for the position. And that's not unbearable, but still that's $4. And that's quite a bit of decay. So I try to get this balance of time decay versus IDV starting to rise. Now, the point of doing this, though, is to show you that when we compare the 7 and the 28 day, then the implied daily volatility for the 7 day is almost 6%. And that's way above what even the short run estimator is. And that is beginning to reflect the fact that we're approaching earnings. And you can see just below that on the top one next to that sort of purple sign, or arrow I should say, see where it says the call sigma ratio? Well, that is the ratio of that implied daily volatility to whatever historical volatility estimator that we were using. And so it's at 1.22 sigma. Now that's actually pretty cheap for an option that's approaching earnings, but it's very expensive given that everything is so sky high. Looking down at the bottom, we can see not only is it the case that for the 28-day, it's not nearly as expensive. It's running at IDV 3.5 on both sides, and the sigma is not even at 1 for at least the 30-day sigma. But again, we know that the distant sigma is more correlated with distant historical volatilities, and so that's a bit misleading there. We look at a few other things here that we need to know about this. We see there's time decay, as we've already said, the position value, and the position cost. Now, when the position value for the 7-day is 51.87, that means a single strangle is going to cost you $5,187. And if we buy the one on the bottom, it's going to cost you $5,793. That's something you have to take into account. These are very risky trades. It turns out that you make money on only about 40% or 35% of them. It's just that when you make a profit, if you do all of this right, it's a very large profit compared to the relatively smaller losses. But do you want to go into a trade where there's a 60% probability, according to your own model, of losing on it, and it's a $5,000 trade? Well, maybe. We need to even look at more. So part of the new model that I'm giving you calculates, for example, the it should say Kolmogorov. I added that this last second. It should say Kolmogorov, Smirnov normalcy test, for example. It gives us our mapping of the histogram relative to the normal. And looking on the right side of this, we have, for example, drift, which we don't care about here, volatility, which is we do care about that. Q volatile is filtering out the kurtosis and giving you sort of like a calm volatility number, sharp, max sigma, min sigma. The really thing that we care about here, as before, is the volatility measure. And here we have an additional year, the 2-year and the so. It's interesting when we take a look at SPY, because I thought we'd better look at SPY, because I know that this is a weird market, and I don't think I want to trade this market unless I know what's going on with the index itself. SPY is not an index, but of course it's a perfect tracker of an index. First thing you notice when you look at SPY is they have a 7 sigma measure in this, and this makes the point about the relevance of that, right? I said earlier in other videos when we got a 10 sigma measure from the demons on one of them. That was on the day that the Dow fell 3,000 points. That gave us a 10 sigma measure on the put either that day or the next morning. Here we have 7 sigma, but you're going to get that, as you'll see, only in the 2-year estimator, because the 2-year estimator was the normal calm estimator. Look how low the volatility was for that, 0.015, whereas the 30-day is 0.047 because of the black swan. And so the 7 sigma is relevant only to the calm period. And you can see down there that it probably was certainly was in the last 90 days and probably in the last 30 days, and yet it's nowhere in there as a 7 sigma move. Well, that's because the volatility measure has increased threefold itself. So it's kind of running at 3 sigma. So that's something you have to realize these things when you're using these all-important volatility measures and comparing them. I'm astonished sometimes when I see the strategy explain where people look at the brokerage's calculation of the IV, and there's only one IV, there's no historical comparison, and people read all kinds of things into that. You can't read anything into that stuff. You have to compare it to historical, and you have to know the trends. But there's another problem here that disturbs me a little bit. Looking at SPY, not Netflix, that's not normal. And when I say normal, I don't mean in the sense you're weird, you're not normal. I mean it in the sense that statistically it's not normal. It does not comply with a normal distribution, and that's why I run the Kolmogorov-Smirnov test. That test rejects this. SPY has turned to temporarily into a non-normal distribution. And that's what I've been saying, by the way, here and there online for about the last 2 weeks. It's a dangerous market to trade when the underlying index loses its normality in a major way. And I'm not just talking about kurtosis, because the Kolmogorov-Smirnov test doesn't measure kurtosis, right? It just measures the shape and ignores the fat tails. And you can tell by looking at this, even by that standard, we are in a weird market. And therefore, models are built upon assumptions that don't accept this are not models that are going to be very good. So that bothers us a little bit. So let's make our decision, okay? We've got the Netflix historical volatility measures. We have yet another model, and this is the decision model. These models are similar to each other, but they have different parameters and they have different output. And this is the one called API Strangle. This is the one that I use before I decide to buy. Then, based upon what this one says, I buy, and then I convert it over to the in-pause model that tracks it. So largely, that's how these models are working together. Some of it's manual. This isn't a daemon model. This one I run when I want to evaluate a purchase that I want to make right then and right there. Now, by the way, also, you know this because we've talked about it some. If I make the purchase, then I turn over the trading algos and let them make the purchase. So that is also automated at Interactive Brokers. I just say, okay, I've decided to buy this strike price, buy it. You know, and so it figures out the price and all of that and makes the limit order and all that and confirms that it got it or not. Well, I just sit there. And the real advantage there is sometimes these markets are so active and move so fast, you can't type in fast enough to keep up with the limit order book, but that model certainly can. This Python stuff, of course, is running in NumPy, not Python, but it has, of course, they're IO bound and have the sort of slow response speed. For that reason, we don't have fast internet connections. They're still lightning fast compared to making the trade with your fingertips. And especially me, I'm so mistake prone that I can't barely get an order in without screwing it up one way or the other. So we've got this one running, and what does this model tell us? Well, some of it's favorable. Here we're looking again at the 9-day option, and so this would be the one we traded. This model selected actually a different put price for us. This one selected the 430 put instead of the 425, and the model's right. If it gives me a different put, it's a better selection than the other. So the model selected 435 and 430. And I was running this model intending to follow up with the trade if the model gave me the indication that I should. So it would have been followed right away. So we get this favorable stuff because the sigma ratio is only 1.07 and it's Friday. Now that's a bit unusual. The sigma ratio, because the implied volatility starts going straight up as you approach the earnings. You'll see it when we track Monday and Tuesday. I'll include that in the next video. Usually by now it's above 2, but the reason it's not above 2 is it's already sky high at 0.05. That's really high compared to, even for Netflix, that's really high. Because usually for Netflix, this is down at normal times, as we saw, around 0.026. And then even, you know, as you get closer to earnings reports, it starts to rise to 0.03 or so. So yeah, it's only at 1.07 times implied volatility, but implied volatility is 0.05. Nonetheless, the model regards the low call sigma ratio as a very good sign. But again, it's because our volatility is so high. But the model says no way when we get to this. Because look at this, we have the call break even. Now, this is sort of like the first two graphs we had, except merged into one as a Strangle graph. And I actually have that mapper somewhere. I just couldn't find it. I've got so many damn models, I'm losing track of where I keep them. If I misfile it, I'll never find it again. And so I couldn't find it, so I can't map it out. But you saw the put side and the call side. It's just that to make a profit, you have to cover the cost of both sides, right? If you're doing the call alone, then you have to cover the cost of the call. If you're doing the put alone, you have to cover the cost of the put. But if you're doing a Strangle, you have to cover the cost of the call and the put combined. At this volatility, 0.05, Netflix would have to go from its current value, 432, to 486 or to 378. And that's just to break even. Now, there would be a little bit of a premium on Wednesday, given that this expires on Friday, so it wouldn't have to go quite this high if you traded out very quickly on Wednesday. But still, it's going to be pretty close to that. And I said, boy, that is a $5,000 trade. We're in a non-normal market in the strict sense of what that word means, and these options are just insanely expensive. And you know, I don't want to, that's a lot of money to risk on something in which you have no confidence. So I follow my trading rules and sadly decided to not trade this because there's just too many things that are wrong with it. Covering that kind of spread is really difficult, even for Netflix, in my opinion. So we will track it though, because the Strangle tracker is just sitting there, and it'll turn back on sometime tonight. And it'll be tracking the two that we decided to monitor. One of them at a different strike. We originally had the strike of 425 for the put. Now it's at 430. That would have been the one we were in. And so we're tracking, I think, the 425, maybe the 430. So we'll know how we would have done, because it'll track right through the earnings report and right up until the expiry on Friday, so we can report back on whether we made a good decision there or not. Now, I think give me my next slide. Okay, my clicker stopped working, so let's move. Oh, this is even worse. I think that this is frozen. Let's see if it has. You know, I can't get through one of these videos without something screwing up. It's so irritating. I could, let's see. Yep, get down here. It's frozen. It actually, what is frozen is PowerPoint. So, yep, PowerPoint's frozen. Let me see if I can save it, and maybe I'll edit this out, or you can just sort of twiddle your fingers, because we're almost done. I'm not going to record this whole damn video. The reason I do these like this is to save time. If I edited these videos, it wouldn't be a problem. But it takes hours to edit a video, and I don't have the time to do that. So let me see if I can salvage this somehow. Okay, yeah, I got it back, so I think I will be able to salvage it. Let me get back into the slide set where it froze up. There's always a problem. Let's see, where were we? Were we there? You can't see that, okay. I'm just about there. Oh yeah, here we are. Okay, let's see if I can get it back. What is this? Microsoft is sending me an advertisement to use something they sell. I hate Microsoft. This is what they popped up when I tried to get this video back up. I was just reading how Microsoft destroyed Skype, right? They bought Skype. Well, Skype was originally independent, then went to eBay, then went to Microsoft. And so, of course, Zoom is everything. Skype's a lot older. Skype is nothing. Nobody ever uses it anymore. And the reason is because it was bought by Microsoft. They're so incompetent. They seem to be destined to piss people off. So here's this. You know, yeah, I want to be present online. I want to use your stupid cloud. I want to log into your completely defunct store. Right? Now get out of my way so I can complete this lecture. God. Hate Microsoft. Okay, sorry. I'll get control of myself and we'll start again. Oh, they just won't let me do it. And it keeps popping the same message up. Boy, you could just imagine how happy I am with this. See, I should have used this little Linux box here. Linux has its own problems in that because it's all free and open source, sometimes the stuff gets a little buggy, although with each passing year that's less and less true. And so, but they're not intrusive. They don't turn into a giant corporation that you develop an active hatred for, like I have for Microsoft. They're just little kind of groups of people who are doing free and open software and being underpaid while doing it. So you really can't get mad at them. Boy, it's not going to come up. I'm going to actually have to stop and resume this. I have to shut down the computer, I guess, to do this. And I'll have to pick it up in an extension of this video. So apologies. I'll be back up online in a few minutes after I deal with the Microsoft generated problem that was not my fault. Those of you who are Harvey Mudd students, you learn to figure out which corporations you're going to hate and then devote your life to fighting against them. Because you're important in the way this technology all works out. You can make a difference. I'm not holding down the control key. Oh, this is going to continue. I'm going to have to go and edit this out. So if you're looking at it live, this is all still here. And if you look at it in the next hour, it'll be there, but I'll go inside the YouTube editor and edit this section out. I actually may just leave it in for the rant's value. You've got to have values as young men and women, and you've got to learn which corporations you want to hate, because you can't like them all. They are really our enemy. Okay, so, oh God, the same message is there. So after all, we're going to, I'll have to present this as two presentations. It's maddening enough to put these slides together under the kind of pressure we're under right now to try to get these things out while we're all in quarantine. To have a giant corporation working against you to try to sabotage your life makes it so much more complicated. All right. So I'll stop this and start it again and call it part 2B, I guess.